just as a reminder, if you have questions, please put them in the chat. I will do my best to answer questions in real time in the chat. And then at the end, we'll have a little bit of time for live Q&A as well. So if we don't get to your question in the chat along the way, we'll have an opportunity to ask and answer questions live. So yeah, it's 2:02. So let's just go ahead and get into it, Josh.
Sure. Thank you, Rob. So this is Lone Star Capital's first quarter 2023 portfolio analysis, where we will be sharing and discussing events and happenings that occurred over the last quarter, both for the company and portfolio as a whole. And so let's jump into it. Over the last quarter, while there was only one acquisition, it might have seemed like a slow quarter. It was actually not. I mean, there was a ton of underwriting going on. And then as you'll see on the next slide, a ton of other work as well. But we did acquire our first property in Dallas. It's actually southwest Dallas, the submarket of Duncanville, which is it's in a quiet residential area and has just solid workforce demographics around there. And the property is about 128 units. It is 128 units. And it's our first foray into Dallas. It's a little on the smaller side in terms of just size and number of units, but figured it'd be a great first footprint into this market that we've been looking to break into for quite a while. This closed in late March. And so we're now currently gearing up to implement our value add business plan there. And I'll get to that on the very last slide as well. We also put 4 properties under contract. So that's what I mean. It was super busy in terms of upcoming acquisitions. So we're not mentioning details here just because we like to be conservative and not count our chickens before they hatch. But these are properties that are under contract. 3 of them we're looking at bundling them as a package deal for investors. And without giving away specifics there, all 4 of these properties are newer vintages and similar, 3 of them similar unit counts, so above 200. And the 3-pack makes sense for us to bundle together. The last property is a smaller size property, but strategically it makes sense for our portfolio just because of the geography of the site. And so when we got the opportunity to acquire that project, we jumped at it. And so looking forward to all 4 of these closing, likely potentially by the end of this quarter, but more likely early to mid next quarter. But so these are all in progress moving forward. And when all is said and done, in our portfolio will be just above 3,500 units, I believe, in total under management. And that's not including the deals that have gone full cycle. So to get to this point, Charles, Rob, Brad, we're all on our team. We're very, very busy underwriting a ton of deals to get to this point. So there was a lot of activity over the quarter on that front. And when these all close, then implementing the business plans and getting everything moving will be quite a undertaking or a task that we look forward to on the asset management side. And to help or assist in that, we've rounded out our team there by adding a new analyst to the asset management team. Very excited to have him. His name's Jason, and I'm sure you'll see him on a call or some other materials coming soon. But looking forward to him adding value to these projects as well. We're also starting to take advantage of, or not take advantage, but leverage some independent contractors just for some more admin tasks and such, so that myself, Dasha, who's heading up investor relations, Rob, Kent can focus on more strategic projects as opposed to just doing admin things that are critical and need to get done, but that are tasks that could be outsourced, so that we can free up time to add more value to investors and tenants alike. We were also quite busy on the debt side in the capital markets. So we refinanced 7 properties. They weren't all exactly in the first quarter, but being that we're showing this presentation today, I've included them here. So the Landing, which was our first deal that we acquired, other than the 2 that have sold. So that was refinanced. We got fresh 5 years of IO that we're super excited for. The other deals here as well. So the reason that we refied, and people might be thinking, why refi in this market with interest rates high? It made sense to get out of the requirement to purchase rate caps, which are super expensive right now if anybody's been following that market, which are priced in association or based off of just the interest rates in general. So the rates that we got we're very fortunate to have received. And again, it makes sense now that we don't have this replacement cap escrow that we were required to have from the prior lenders. And in addition to getting a number of extra years, new years in some cases like the Landing, of interest only payments. So that reduces our debt service. But you can see here, 3 of them closed on April 6th. That's all with the same lender. Then there was another deal, Park, closed on the 17th. That was with the same lender originally that we used. And then Broadstone just closed. Madison should be closing in about a week or so. And those 2 are both with the same lender, the 2 of them. One of them had the lender prior on its original debt, and the other one's a new lender. But what's also great about these new loans is for 2 of the properties, we had basically DACA, I believe it's, I don't know if DACA accounts, but they're controlled accounts, essentially where rent would have to go into basically an operating account or a savings account at an associated bank. And then they would sweep the funds over once a month, or pardon me, once a week. So we don't have that requirement anymore. And it just really helps manage cash flow. We're not beholden to the lender holding back these funds and sweeping them, because our our mortgage payment is due on the same day every month. But let's say the mortgage payment is due on the 6th, which happens to be a Tuesday, and our rents get swept just every month on a Wednesday. Then it makes things complicated and we have to move funds around. So it's just one less thing to worry about in terms of cash management, which is obviously, as I'm sure everybody knows, super critical for a plethora of reasons. So that's one more advantage of getting out of that old debt. I don't know if, Rob, you want to share anything here or at the end?
Yeah, what about construction draws?
Say it again?
Construction draws, Capex.
Yeah, absolutely. Good point. So we were running into a scenario again with cash where we would have to pay for Capex up front and then get reimbursed by the lender. And each lender has its own set of templates and set of rules. And a lot of times they're just checking the boxes, to be honest. And I mean, they have these processes that we have to follow, but it's a little bit cumbersome and just added to not only our work, but work of the property management team, and would delay a lot of times the reimbursement of funds. And so then that would create another issue again with cash flow. So it's one less headache that we have to deal with. And one of the lenders actually is holding back Capex. So the majority of these loans or lenders are not holding back any Capex. They released all the funds to us ahead of time. So that's amazing. The one lender that is holding back funds was willing to do 2-party checks. So basically we can get a project done and have the lender directly pay the contractor. And this will, alleviate any back and forth between us, the general contractor, and the lender, and also the cash expense as well. So we don't have to outlay anything and we wait to get reimbursed. Simply funds go from the lender to the contractor. And in addition, Jumping off this, we're also, we've started to bring construction in-house, mainly for unit turns and painting and interior projects. Just usually unit turns and regular R&M. But we're looking to further build it out for other projects, you know, in a little bit larger scope, some exterior work and such. And so this will further alleviate the need for contractors and, you know, having to take funds, reimburse others. It'll simply be in-house. And on top of that, we should be able to get better pricing or better cost metrics, because there won't be a contractor adding in some sort of profit multiple on these deals. Anything else you could think of, Rob, or no?
No, I don't think so.
Okay. Yeah, but very, very good point. I meant to mention that, so thank you. Looking at Capex, speaking of which, two of our projects are pretty much done. The landing is not on here. That's completely done and finished up right just under budget. There's a couple of percentage points under budget. And the reason that we were able to do that, and that Solano's coming in under budget, Hollister as well, first and foremost is conservative underwriting. So we're very conservative when it comes to the Capex plan and what things are going to cost. When we actually go forward and make the further refine the Capex budget with our on-site property management team, they're conservative as well. So they're taking the initial general buckets of cash that we've outlaid for interior, exterior, certain projects, and are being very conservative there as well. We also build in a 10% contingency to every project. So we have extra funds should things pop up, which, you know, they always do. Extra repairs, whether it's plumbing, electrical, you know, wood, structural, there's always something that pops up. So we bake in additional cash just for that, for the unexpected. In addition, when it comes down to actually getting bids, we go out to a number of vendors, and we also get preferred pricing by using same vendors multiple times. And, you know, by bringing more business to certain vendors, we're able to negotiate better prices. Obviously, that's just how supply and demand works. And we're also seeing that now with just COVID and the supply chain is starting to open up, and this stalemate, if you will, is lessening. And so we're now seeing the prices of granite and stainless steel appliances come down, especially if we're buying for an entire site and doing it in bulk. We're seeing prices come down, and the ability to implement or install the devices much quicker. So those are all good things, and the reason that we're able to complete these projects on budget, both time and cost wise. So yeah, very, very busy quarter Capex wise. We're wrapping up some of these projects here, Encore Park, Broadstone, Timberwalk, Five Oaks. Honestly, all those, the exteriors are pretty much all completed, and now we're moving forward, continuing with our interior renovations, which do take longer just because we have to deal with you know, occupied units and such. And we're usually doing these at turn, except for granite, stainless, things like that, where we're getting a bulk package deal and go in and do all these even in occupied units. So looking forward, or getting into the actual day-to-day operations here. So this is showing our P&L, visualization of our P&L, income, expenses, NOI. And one thing I wanted to point out here, just the time of year. So it's now Q2. We've just had to pay taxes. So beginning of the year, obviously that's paramount for everyone, whether you own a business or not, your own income tax. And so just the difference in two properties. So we escrow for our expected property taxes, and sometimes they come in under, sometimes they come in over. So you can see here, this is Broadstone, which was acquired almost just about a year ago, almost exactly. And so in February, our taxes here way under the budgeted amount. That's the reason for this large gap or delta here. And the reason for this overperformance in NOI. That is because we had overestimated our taxes. And so when we went to pay them, we were able to reverse that. And it was essentially writing that down. If we look at Encore, I believe it was, so the opposite happened, where our escrow was slightly under the end result of taxes, which came in higher than we originally estimated. And so you can see here, our tax expense was larger than our budget estimation, and that's the reason for this delta here. And so by looking at this data, basically the point of this is to make our escrows more accurate and refine our data for next year and the year after that and be more precise. Again, it doesn't matter a ton as basically we're going to reconcile this at the end of the year. However, it does matter for just our overall cash management and such, and being able to precisely stay on track. But so that's one reason for that delta there. Another thing that we're looking at in this time of year is now we're going into the busy leasing season. And so we want to keep an eye on our marketing costs. And then up here in total rental losses, we want to look at our concessions as well. We will be offering some concessions, more so some not really concessions in terms of a free month of rent or something like that. But we're trying to get creative with it. We are offering for the month of May, and this is portfolio wide. We're offering for every lease that's signed a chance to get entered in a lottery. And this is portfolio wide, and so there's a chance to win, I believe, a TV, an Amazon Echo Dot, or an iPad. So just a way to get entice prospective tenants and fill our properties, increase our occupancy. And so by doing so, obviously there's a cost associated with it. So we want to take a look at G&A, marketing, and then concessions as well, and make sure we're not going out of line here. But again, this is the busy marketing leasing season, and so we do want to take advantage of people moving, and there's competition among sites, and it's just one additional way to differentiate our properties above the amenities and customer service. So this slide, I think, is indicative of just data in general. Is one thing that I was thinking of last night when I was reviewing this, and it's we have all this data here. You can see different metrics here, month over month, 3 month change, average rent by square foot. So we have all this data, but if you can get inundated with data, and if we don't have an easily digestible package, or we're just swamped in data, but it's not offering any value, you're not able to act on it, then it's just a waste. So one thing we're constantly looking at refining and getting better at is just having data simplified so that we're able to take it and make tactical and strategic decisions for the short term and long term of the properties. And so we have all this data, but we have it aggregated into a series of different dashboards and metrics that we look at, which are more targeted and specific, so that we can better judge the health of the properties and the value that we're returning to investors. So this is a property that we mentioned last quarter. This is Solana. We mentioned because, as you can see, there was a large dip here at the end of the year. There were quite a few evictions that took place that finally all went through. And this, I believe, you'll see on the next slide as well, that evictions continue to take a while to go through the courts. There's just a backlog still, even though COVID is, for all intents and purposes, it's behind us, the pandemic at least. And so courts are still taking a while, so that's the reason for this dip here. However, the point that I bringing it up today is we've really rebounded from that. Kudos to the property management team, just being out there and making this happen. So we're back up to 94.3%. It's a huge change. I mean, you can look just 3 months. I mean, 2% over the last 3 months, just going up quite a bit. And so they've done an amazing job there. And one other thing I wanted to mention is, so this bar here, this yellow, are our one by one bedrooms. We also have this unit here. The A type model, I believe, is a 790 square foot, whereas this is 850 or thereabouts. So it's slightly larger, and it is slightly more expensive. And so we're seeing that tenants are either going to the A unit or they're going for a larger 2-bedroom unit. And that's where you can see here, it's been pretty much flat. And you can see here in the, drilling down the data furthermore, the 1 by 1 A unit, there were 8 move-ins. There was actually 1 move-in for the B unit, but that was negated by a move-out as well. And then the 2 by 1s, there were 3 move-ins and 2 move-outs. So, that's what we're seeing there. I'm not sure that there's, much we can do really to boost performance, other than, I mean, this is a specific potential tenant who just wants that extra space and is willing to pay the small premium for it. And then if we look at, so this is one other thing I just saw while digging through last night. So you can see here the Hollister, there's a ton of different unit types, but this looks quite drastic. But then if you drill in a little bit, so this is the G layout. And if you look here, the very first line there, G, there's only 1 move out. And you can see it dropped to 67%. The reason it looks so drastic, there's only 3 of these unit types. And so that's the reason that it looks like it's such a sharp dip. But as you can see, there was a move in the next month, and so it's rebounded, and so not as severe as the image makes it look. If we move on, so this is looking at cash flow, delinquency as well. This is Encore on the Bay. This was acquired in November of 2021. And so you can see here there were this delinquency here that I want to highlight. This is the 90+ bucket. So what happened was these tenants basically just weren't paying. They were in eviction housing court. Finally, they got, we tried to work with them, but just didn't end up going through. They were evicted. It turned into bad debt, unfortunately, but now you can see here that we've really gotten away from that. And delinquency, well, it might be slightly high in this 0 to 30 bucket. It's not moving into the longer term delinquency, which is exactly what we want to see. So again, this is kudos to the property management team and knocking on doors, collecting any overdue rents if there are. But you can see here that collections in general is quite consistent and actually trending upwards, which is great, albeit ever so slightly. One thing I did find interesting, just looking through all the different properties, the dates of when payments are coming in are really consistent. Just in terms of, so like you can see January, everybody's paying their rent right away. This is down here. This is the amount of collections over the day of the collection period. So not day of the month, but this would be the first day in the collection period. So January 1st or February 26th, March 26th, which is the start of the collection period. Going forward, we go from the 26th to the 25th is our monthly accounting period. But so January is quite out in front. Then February, I guess people are tired after the holidays and just kind of forget to make their payment on the 1st, so it gets a little bit slightly delayed. Then March, people kind of snap back into the swing of the year, and they're back, making payments earlier. So obviously we want to see as much cash up front in that first few days as possible, just because that helps us plan out the month. One system we are gradually moving all our properties to is Profit First system, which there are books out there that anybody can go about and read. But it's just a way of basically tracking income and expenses and making sure that everything's taken care of upfront and basically a month ahead, so that cash management is always managed well. And so that's something that we're really pushing and focusing on with all our properties going forward, and the refis that have gone through as well, because it's just a great natural segue to begin over. So we're looking at doing that there, and I think it'll really help us. This is something that Kent and Rob have really been pushing, and I'm totally bought in on it as well. So a great book if anybody wants to go check that out. There's a number of books on Profit First is the system. But if we look at, let's just say Broadstone, for instance, same thing. So January payments come in early. February they come a little bit later, and then March they come back. So interesting. But another thing to mention is this 90+ bucket here is indicative of the backlog in housing court with evictions. So this is anything 90+. So you can see it's not really growing. It's pretty consistent, and that tells me that there's one or two tenants here that are just not paying, and it's just backlogged in housing court, and eventually that'll get cleaned out. But it's one more issue to deal with, and hopefully the courts get cleaned up and things get back to usual. Ideally, we won't have to deal with evictions, and if people need rent relief, there are still some funds available out there. But unfortunately, there are evictions from time to time, and if need be, we just much prefer that they move swiftly through the courts. So this is looking at rents. So this is for the entire property, everything in aggregate. Our actual rents compared to our market rents. Down here is new rents, just in general. So any new lease for that month compared with what its market rent was. So this is basically a subset of this data. And then furthermore, same thing here, this is just renewal rents. So you can see that on our renewals, we're averaging about $50, call it $50 basically a month on our renewals. Some months it's slightly higher depending on the unit type. And we're steadily working up to being even property-wide in aggregate. So that's all entire units at our market or pro forma rent. So we're almost there. Our delta is $29 in aggregate. Month over month, we increased or closed that gap by 0.3%. So great news there. Here, there wasn't much interior Capex that we did other than some washers and dryers and such. But you can see here that, especially in the last couple of months, we've been getting a premium, $40, $30 over our market rents. Again, this is just for those particular units that were leased. So great news there that people are continuing to move into the property, occupancy staying strong, and we're able to achieve these rents. I'm sure everybody on the call here is reading about rent growth, not only in Houston and Texas, but across the country, and what markets are going to remain hot, where is rent growth going to cool. And so there's just a ton of information out there, but we are still seeing rent growth. Whether it remains at 5%, we'll have to wait and see. But across our portfolio, our properties are still able to get the increased rents that we're offering based on our renovations that we're doing at the properties. So again, this is a ton of data here. We would dive into each one of these separately, and this is something that we look at with our property management team. We're actually soon to be rolling out a new property management focused dashboard for our weekly calls. So we have a call every Tuesday, which is an asset management call where we go over the status of every single property, what's going on with occupancy, delinquency, collections, staffing, if there were any critical issues that might have happened. So that's every Tuesday. And then every Thursday, we have a Capex call strictly dedicated to our value-add business plans and where we're at there, progress of our projects, comparing to budget, comparing to underwriting. And so we're kind of shifting around our reporting system, where we had one report that would come in and it'd have just a ton of data. And then it'd be, essentially be like, well, so what? So what are we doing with all this? And so I think, when it finally rolls out shortly in the next, hopefully month or two, it'll just be much easier for us to interact with the property management company that we work with that, is in under our umbrella. And, we'll have the data and be able to say, okay, so, X equals Y, what do we do now? How can we clean up delinquency? Whatever it may be. So we're able to just act on that information rather than trying to make sense of it. But one thing here, I know I don't have a ton of time left. I don't want to take too much time. You can see by and large that the majority of our leads, at least, are coming by, people driving by or going into the property. We do put quite an emphasis on the grounds and such, landscaping. We're also there was an old pergola and storage shed that we tore down recently. So that will further make the property look better. We're putting in a brand new playground there. But clicking into this for any given month, you can see what portion of showings, applications, and then leads it turns into. And so, or pardon me, leases, not leads, but leases. I mean, it's gathering quite a bit. 11 leases in November. I mean, you can work through this and see if ever you wanted to. But you can see it garners, quite a large portion, as do resident referrals. So referrals is pardon me, this is our website. So people do look at our website, which is great. We've revamped all of those. We're revamping the Lone Star website as well. Resident referrals, and then we are going to have, as I mentioned, I believe a big banner outside properties or on the streets where we are mentioning the May, I think we're calling it a May extravaganza, where we're offering chances to get into this lottery and potentially win some electronics if you do become a tenant in one of our communities. And then one other thing is just, this is important, looking at our renewal rates. And so April was great. Everybody that was had a notice to vacate or was up for a renewal renewed. So that's saying something great. And we have to take a look at here and see why this was not as strong a month. Could be a number of different reasons, but obviously we want to see long-term data, but this is a healthy sign, at least for that month. And so moving forward for Q2, which we're already in, our plans here, we've got a ton going on. So we're going to close the refinance on Madison at Bear Creek. That's first and foremost. That should be happening again next week. We'll be kicking off Capex at Candlelight. We've already started just gathering bids and such. We have our plan that's been refined. One other thing I wanted to mention that I did not mention before on the Capex slide was another reason that we're able to keep on track with our budgets is that we're flexible and adaptable. So, if granite or whatever it may be is coming in too high, we're not going to try and force it, force a square peg through a round hole. We're going to look at, well, is there something else that we could do, whether it's interior or exterior amenity wise, that could justify the rent bumps that we're going to be implementing. So, we're not so stuck to the business plan. We're able to go through and if need be, adjust and recalculate so that we are able to ultimately get the end result, which is rent increases. But to kind of light our budget here, about 2.1 million. It's broken out, I believe, about 70-30 between interior and exterior. So 70% of that will be towards interior. Again, there is a 10% contingency built in as well that will go towards interior or exterior, as needed. If we don't need to spend it, then we certainly won't. But just here you can see scope, and this is pretty standard across our units. We're going to be doing counters, new cabinets, stainless steel appliances, washers and dryers. We're not doing any sort of smart technology package here. Just don't think it's needed for the demographic. And then we'll be enhancing the amenities at the site as well. And then moving forward, one other thing to be on the lookout is a case study that will be coming out, in the next few months or so. But it's looking at landing at Pinewood Park. And the refi there. So that's something else to take a look at, but we've done, or Rob has done, Rob and Charles, 2 other case studies that are amazing to look at, just looking at deals that have gone full cycle, from start to finish, issues that came up and how the team was able to mitigate them and ultimately end at the end result. So very, very interesting to read if you have time, and just check out. But I do see there's one question there. I don't know if there are other questions, but I've, said all that I want to say to this point, but happy to answer questions, or Rob can as well if you have them directed for him. But just want to say thank you, everyone. Hopefully found something interesting, or if you have a question, please feel free.